David Patrick, Fitzstock Charts, weekend market analysis. Charts Way Sleep, week 11 for March 16th, 2019. We're in a 5-day uptrend, and this year has just been amazing. Amazing. And I say that after we just had a year with 11 uptrends. We've never had, I don't recall, for the 20 years I've been trading, I don't recall ever having 11 uptrends. So we just were handed a free gift last year with 11 uptrends. Not only the free gift, we were able to go cash in October when we broke a huge uptrend line. We had all the cash in the world when we went into this bear market, and then we started a 40-day uptrend this year where we made a fortune. We got knocked out of trend. What did I say when we got knocked out of trend? I said, look for pivotal lows, which always seems to happen the week before option expiration. That just happened to be last week. What did I say? I said the market often flips a switch and it doesn't remember anything that week and then just starts a new week, which is exactly what happened this week. 1998 historical chart pattern comparison has a golden cross. A golden cross. It's pretty bullish. Apple. Knocked it out of the park this week with Apple. We had it on the ESFL from earlier in March. Those options doubled. I put it on Thursday. I've already had Apple on. I added with some weekly options that doubled in one day. One day. 90% clubs going through the roof. And I tell you what, you have to stop with the excuses. I know I don't have them. I hope you don't have them. You have all the answers right in front of you. All the answers right in front of you. You have a methodology that works. You have a methodology that is producing insane results. 90% winning percentage this year. 90%. 90%. 9 out of every 10 trades are winning trades. And many of them have doubled. We'll get to the 90% club in a moment, but I say it over and over again. If you're struggling, you need help, I'm here to help. Even if I have to call you for 10 minutes. I want you to make money. You have to make money in the uptrends. I've said that over and over again. And I know most of you are. But I want everybody to. I want everybody to have no excuses and trade like a robot and use the methodology and print money. 90% club. 73 doublers this year. We haven't even had 73 trading days. So, I mean, well, have we had? I don't know if to go back and look. And that's just crazy. Crazy, crazy, crazy. 1,015 different options that are up over 90% since we launched service. 27 triplers year to date. Crazy numbers. Now, these numbers aren't based on earnings or Fed or non-farm payroll or anybody's projections or analysts. Nope. They're just based on simple rules of engagement. Price patterns that repeat themselves. Calculated entries, defined risk. That's all they are. So once again, we're in a no excuse atmosphere. You need to be on the right side of this trend. Okay, and by the way, you know I came in, let's see here. Well, we don't have the, hey, we do over, the Dow Diamonds. I wanted to show you the downtrend. See, in October, you can't see it right here. I'll show you the S&P in a moment. You all know I went to cash. I posted it back in October. But anyway, when we came in the beginning of the year, I think I started out 40% long, 80% long, 130% long, trimmed it to 100, added this and that. I was 130% long at the gap up right here, scaled down 80% long, went to 40% long, somewhere in here, and then all cash. I even sold some down in here. Near the lows. At profits, obviously. Well, I don't want to say obviously, but yes, at profits. And then what did I do this week? I came in like a robot. And by the way, just to let you know, I had 0% long market exposure. And you all know that because you see the daily updates and you see me on Twitter. 0 long market exposure on Monday morning on the gap up. And I crushed it this week. Crushed it. With simple rules of engagement. Found out what met my risk profile. Found out what was showing relative strength. Found out what looked like a good historical chart pattern comparison, which was the QQQ and Apple. And I swung and I hit it out of the park. And then on top of that, I added spiders. I basically doubled up and bought SPXL, which is triple long. And some people were wondering what I was doing, buying the highs on Thursday. And I said, you know what? It's okay if we pull back and test moving averages. That's all right. I'm risking, I even posted what I was risking. I'm willing to take that risk. So maybe not all of you are, can stomach a triple long, being 110% long market exposure, but you should be fully invested, whatever your comfort level is. Maybe it's 75%, 80%, whatever it is. Maybe some of you like to see 10%, 20% cash, 10, 20% bonds, whatever it is. In uptrends, you have to be fully invested. So you shouldn't have cash in uptrends. So anyway, I have the Dow Diamonds on the right. I have the Dow Jones Industrial Average on the left, 1998. We talked about this golden cross, historical chart pattern comparison. What happened after the cross? The market just ripped. And I do think I think the same thing's going to happen. I think we're going to go blow out highs. I talked about 2,900 in the S&P, and I don't think we're going to stop there. So this historical chart pattern comparison, I think, it's not identical, but it certainly is paying us. And, I was looking, and once again, not all historical chart pattern comparisons are going to be identical with moving averages. And you have to understand that. Like, for example, the one I was using on Apple, you might be like, holy cow, it doesn't look at all similar. Well, I was actually using 2008, and I've showed this one before, and the moving averages and stuff like that are not that similar. The Fibonacci's are very similar. So you can see this is 2008, some kind of U bottom, consolidated. This consolidated right at the 200 or above. This time it consolidated below. But this consolidation, and the reason why I bought 250 calls on Thursday, well, number one, I was playing with the house's money and then some, but number two, once you see this price strength confirmation out of a nice bullish consolidation, which we saw here in Apple on the right, let me blow it up so you can see it. This bullish consolidation, and we saw this breakout. This candle right here is an iffy candle. It's a spinning top, right? Spinning tops show us no conviction. We came right back down. This was a good, because you knew when you came back up this triple top area, when we saw a strong candle, was really going to rip the face off the shorts. And that's exactly what happened. And you can see exactly what happened here. Once this MACD crossed and started heading back up, you easily did a 100%. Easily. All right. Now, we're already at the 100% too. So, I mean, I've cashed in 200 of those calls. I think I'm holding 50 right now. I'm probably going to look to buy dips on different weekly ones because I still like this one. And I still think, if we see, you can see right here, if we still see some dips, probably going to buy them. I still think we will see dips. I think we're getting up to 191, maybe 194, 195. I plan on making a lot more money in Apple. But with that said, I'm going to define my risk if I'm wrong. There's always a what if. And I probably will use this low of Friday as my stop on anything I put on that I'm adding going forward. I'm going to use that as a stop. I don't want to, I swung and I went out of the park with this. But with that said, I don't want to risk more than 50% of the profits. So I'm going to define my risk at Friday's lows. So, and then I'm long QQQs. I exercise those options. I hit spider calls instead of exercising. I went with SPXL. And so right now I'm 110% long market exposure. The SP is up 22. I don't know where we're going to close. Maybe we close red. It's not about that. It's really just about, You have to take we always talk about this, and I have a lot of trader consultations that I always talk about trading demons. Emotions and opinions are everyone's trading demons. And if you cannot get the emotions and opinions out, I'm telling you, it's like that movie Groundhog Day. You're just going to wake up the same time every single morning. You're going to grab that alarm clock and you're going to throw it on the ground because it's the same thing over and over and over and over and over again. You're going to live the same moment until you make change. So if you're not participating in uptrends, you have to do something different. You have to. I want everybody, every single person in the service to make as much money as possible when we're in uptrends. When we're in downtrends and no trends, I want them to preserve their year-to-date gains in capital. That's what I want. You don't always get what you want, but that's what I want. So what we have here on the SPX is price strength confirmation, break of a downtrend, MACD's curling up. And I think we get up here to 2,900. And I think we eventually get further. And I think once we get up here, things are going to get more volatile. But we had a death cross here. You see what happens? Why can't we see 2,900? I think 2,900 is I don't want to say anything's easy in the stock market, but that's a very, very, very feasible or easy price target to hit. I mean, if we're doing a Fibonacci extension like we just did with Apple, and you do the extension from here to here, it's easy 2,900. And I think we easily get to that measured move. Now, it doesn't matter what I think. Like I told you yesterday when I put SPXL on, when I exercise QQQ, I already know where my risk is. Right? And someone asked me, I thought you normally take the previous day's low as your risk. Well, yeah, I'm high stacked on the year. I don't want to get shaken out of something that still is bullish because the higher time frame is. So what I'm going to use, and I posted this yesterday, is I'm going to use the pivotal lows. The pivotal lows that we just saw. Remember the pivotal lows from the month before? Yep, we're raising our stops again. And you'll see it on the daily updates when I finally update that. I've been trying to update everything, and I apologize with the 90% club. I'm going to be updating the website. Just did a new logo. I'm doing a lot of things. So when I update that, you'll see. But with that said, yeah, that's our new line in the sand. And if we break that, that doesn't mean we're going to new lows. It just means the market's becoming more sloppy. When it becomes more sloppy, we want, once again, to have, we talked about that analogy last week. Do you want to go to the MGM at 50-50 odds, the win at 70-30 odds, or Caesar's Palace at 90-10 odds, or whatever? I'm just saying you want to go to the highest probability. Those are uptrends, all right? And with that said, we also want to give ourselves room to make money. So, yeah, I was risking, I don't remember what it was. If I'm 20% long and I'm risking 10% on that trade, 20%, I'm risking 2% of my net portfolio. That's not that much. It's not that much. Even if it was 5-6%, that's not that much. And you have to understand that. The Qs, I think, were even less. I think I was risking like 1.5%. So give yourself, when you use those pivotal lows, if you're not comfortable being 110th, 130, 150, whatever, if it's 50% long, whatever it is, give yourself room to work. If you're just going to always go with the previous day's low, that's fine. It's a hybrid trader. But when you see this kind of market conditions, you really want to give yourself a little bit more room. You don't want to get stopped out of a good trade. I don't want to spend too much time on this. But, all right, so we talked about the pivotal lows. We talked about, I said you don't have to short the downtrends. The ESFL. That was one other thing I wanted to talk about. Yeah, I think the other thing was just my trades. I don't want everyone to be overly consumed with just my trades. You got to remember they're supplemental. The focus of the service is what? Understanding the methodology, number one, right? Number two, understanding we make money in uptrends. And number three, we're placing trades based on our focus list that comes out every day. That's what I spend all my time on, is scanning the charts, looking for relative strength, calculating the entries, and calculating the risk, and having defined risk. So that our spreadsheet, our focus list, is our focus too. Twitter is not an essential component of the methodology or the service. By all means, it's supplemental. You don't have to have Twitter. If you do, that's great. But sometimes if you have Twitter, you're a little bit confused. There's so much going on. There's day trades, there's swing trades. And that's really what I wanted to talk about here, real briefly, is understanding time frames. Because I posted on Thursday, and this is when I'm 120% long market exposure. And what happens? Probably 10 minutes later, the market didn't look very good intraday, and we were posting an MA topping pattern. And I don't want anybody to think I'm talking out of both sides of my mouth, because I'm not. I was 120% long market exposure in my swing, long, investment, retirement, all those accounts. Right? My trading account, which I disclose all the time, is my short-term money. That's what I do for my day trades. That's what I do for the 5-minute rules of engagement. And if you are aggressive and you're doing it, I suggest having separate accounts. Or not even paying attention to 5-minute rules of engagement, because you don't need to. All you need to do is understand how to be swing long. Look at the 90% club. That's all you need to know how to do. Everything else is just icing on the cake. My supplemental trades, my Twitters, the videos, all this jazz. All you need is the focus list. Everything else is supplemental, so make sure you understand it. Before we get into the rest of the stocks, I just want to understand multiple time frames, right? What do I mean by that? Obviously, day traders are looking at 5-minute charts. Swing traders, which are most of you, are looking at daily charts. And then our higher time frame, which is always in charge, is our weekly. And that's the reason why I said last week you don't need to short stocks. The weekly chart is still in charge, and it is still bullish. So before we get into the rest of the stock charts, let's just look. What is the weekly telling us? Let me get rid of some of the stuff here. We'll find out. Once again, I don't want anybody to think I'm upset. I'm excited. I yell a little bit when I'm excited. But this is phenomenal stuff. I mean, we're having a great year. We had a great year last year. I'm very, very happy the way everything's going. I just want everybody. I mean, I set high goals for myself and for the service, and I want everybody. I don't want anything less than everybody succeeding when we're in uptrends. Okay, so with that said, what is the weekly telling us? Well, we need to be above the 10 SMA, which is the green one, right? 1, 2, 3, 4, 5, 6, 7, 8, 9-week uptrend on a weekly higher time frame. We're in a 9-week uptrend. We're still above, and we are seeing a mini golden cross 10 through the 50, and MACD's bullish. And we talked about that. When all stars are aligned, I usually get leveraged long, which is over 100%. That's a break of a downtrend. That's a bull flag above MACD, and it's exactly what happened back here when I was leveraged long, right? MACD bull cross. This was a little bit more powerful because it was a bull flag to new highs, with MACD confirming. This is a little bit less powerful, so I have a feeling, 2,900, maybe a little bit higher, things are going to get more sloppy. Heck, we'll deal with that when we get there. We get to 2,900, we're hitting it out of the park, right? Again. Okay, so 19 minutes in, let's fly through some stocks. Here's the NASDAQ, looks really good. MACD bull cross. Don't pick tops. Ride the trend. /CL. Oil futures. You got a head, left shoulder, right shoulder. It's below the 200, sandwiched between. Not a lot of momentum there. We'll look at some stocks. Let's look at them right now. XLE. It's been very sloppy and very hard to trade that sector. So why are we going to trade it? XLF's looking better. It has to get above the 200 SMA. When it does, I think you're going to finally see some stocks in that sector setting up. IWM is lagging. What's leading? SPX, QQQ. I'm long SPX, QQQ, and Apple, right? You want to buy and hold the things that are leading. IYT is lagging. It led before. It's lagging now. IBB, lagging a little bit. It's not seeing price strength confirmation. You are starting to see some stocks in that sector that are looking pretty good, though. Gold, very sloppy. MACD, bull cross looks like it might be coming. But you're below this uptrend line, above this downtrend line. That is just slop, slop, slop. I don't like it. TLT, I'm bullish. Bonds, I'm long. JP Morgan preferred, 6 1/8%. It doesn't fluctuate a lot. It pays me a nice dividend. And if I wasn't so long the stock market, I probably would add to that. But this is just a slow-moving grind. I do think bonds eventually break out the 52-week highs in the year. I just think there's no momentum there. It's going to take time. I don't think it's a great trade. I think select bonds or select preferred stocks are decent investments. That's about it. Apple, yeah, I do think we're going to the 200-day moving average. That's 191. You know I'm long. Actually, I'm ultra long because I'm long in my investment account, 10%, and I'm long in my trading account, 50 calls. It's 5,000 shares worth. So, and I'm telling you what, I'm probably going to even have more because as this thing pulls back intraday and I'm going to use 500 ROE, I'm going to load up even more because I still like Apple. But once again, I'm going to define my risk versus Friday's low. So we're crystal clear on that. Amazon. Sandwiched between moving averages. Do not love it for either a long or short. Netflix grinding nowhere. No momentum right now on Netflix. Booking, Expedia. They have not been anything really to talk about in quite some time. Tesla. Yeah, I mean, it looks like it went lower, but every time it does, it goes right back up. Facebook's getting very, very, very sloppy. You double topped here. This almost looked like a cup and handle. Then I think some bad news came out. MACD bear cross. It's all over the map. There's no momentum. For a new trade, I wouldn't touch it. If you're stuck in it long, sell some covered calls because it's not doing anything. Google, I like a lot. Apple, I like a lot. NVIDIA, we talked about this. I still think this gets to 180. How long does it take to get there? I don't know. Intel, I like a lot. Texas Instruments, I like a lot more. Microsoft, I love. Oracle, that's a nasty candle. Oracle was looking good. AMD, Micron, not so much. Avgo, very good. Interesting candle. OLED, just phenomenal. That's, I believe, in 90% go at least once over the last month. Light looks good. And then Xilinx. Let's take a look at this one. We talked about this one. I said, I think this is going to new highs without MACD. And once it gets up there, it's probably going to consolidate again. It's not a great new setup here. It was a month ago, right? Because our number one price patterns both flagged the new highs with the MACD. This is where you get long. And just like with Apple, it's where you get long with size. Put some size on. All right. So Xilinx looks okay. It's just, to me, I'd rather be in other stocks. Okay, so Adobe. Adobe's sloppy. Coop, huge day the other day. MACD starting to curl up. This one might be looking for much higher prices. Now it looks okay. CRM, Workday, just grinds right now. Splunk. Yeah, I don't see too much new there. FFIV. Team looks good. So we probably only have a handful, as crazy as this sounds, a handful that I like. Roku, no. So let's look at the Chinas to see if we can see anything. Baba, no. Baidu, grind. There's just no momentum there. CYBR, yes. Panwa, no. Vive, yes. That's about 7 stocks. YY, NTS look okay. Shop, yes. So we probably got 8 or 9 stocks right there. GoDaddy, slowing down. SQ, Wix. Let's see what PayPal looks like. PayPal, yes. That looks like it wants new highs. I think that's the 9th stock. JP Morgan, I tell you what, if the 200 moving average wasn't there, I probably would say giddy up. And I might even take that long. I just don't like that moving average there. Goldman Sachs, grinding nowhere. I like Bank of America, probably the best out of all of them. Just not a ton of momentum here. MasterCard, Visa, if you have to pick two, you got 9, 10, 11 right there. MasterCard, Visa, I like those a lot with the PayPal. CFCME has come back to life. Yeah, I have a feeling, just a feeling. Obviously, this is not a bullish pattern at all. But I do have a feeling it's going to come up here to 10 SMA. It has to, the high odds that we're going to do a double bottom or at least break to test that bottom because those were confirmed. And then I think once that happens, then you might see a short squeeze. But I'm not going to predict that. Right now, it looks like death. It looks horrible. CBOE actually looks the best out of all of them, which is crazy. Let's flip to oil. COP, no. When I say no, I mean there's just no momentum. CVX and Exxon looked the best before. CVX probably still looks the best here. Why would I buy CVX when I just named 11 other stocks that looked better? Get to those casinos. Let's see what the odds are. And the odds are they're going nowhere fast. Docu looks okay. Amgen, Now, these stocks looked so bad just a week ago. Let's see if any of them have. Alexion looks decent. I think RSG looked the best. Yeah, I still think that one's going to new high. ISRG, Alexion. X-Ray looks pretty good. Needs price strength confirmation. UBNT. Like it. I do think the problem is you have rules of engagement. MACD is actually still heading lower. It's just a tough new trade. I think it does go to new highs, but it has no momentum, so you have to be very careful. Twillo, yes, so that's probably the 13th, 14th, or 15th stock. And CMG looks very good. Chipotle. So let's just say we have 15 stocks. The S&P is up 22 handles. We got 15 stocks that are showing relative strength. That's all you need. If we only had 4, I'd say, maybe a little cautious. If we had 10, I think I'd feel pretty good. We have 15. I feel pretty good. I mean, the indexes look good. I don't care where we necessarily close on Friday. I know it's 1 o'clock and things can reverse, especially on OPEX. I understand that. What I do care and what I think is relevant, I think is very relevant, is what we talk about all the time, these pivotal lows that get put in on the week before OPEX, right? That was 26, 71 or 81. Now we have new pivotal lows. Those are our pivotal lows. 2722, 2722, 2722. Write it down. That's your low. That's your line in the sand. So if you have any excuses on why you're not in the market, say, hey, I'm willing to risk XYZ dollars for 2722 as my stop. For some reason, if I'm not long enough this market, that's my stop. You already know where your risk is. You already know where your stop is before your entry on every single trade. You know all my entries, all my stops, all my scales, all my stops. You know everything. You have all the answers. You have the rules of engagement. You have the methodology. You have your ESFL. You got the video updates. You got Twitter for supplemental feeds. You have everything in front of you. Tune out everything else because it doesn't matter. The only thing that matters is price. Price is the only thing that pays you, and price is in a 5-day uptrend. That's all I got for you. Charts while you sleep, week 11. Have a great weekend.